Well, Herman, welcome to this special edition. We are calling the Big Policy Reset, the Big RBI Reset, and that's pretty much how it's played out as Governor Patel unveiled his maiden policy, where he announced under the new MPC model, the new Monetary Policy Committee model, its first rate cut in the policy meet. Let's talk about that through the course of the next 30 minutes with all policy watchers as well as market watchers, and what this policy announcement would do for the economy going forward and what would it do for the health of the markets as well. It's been some debut for the new governor at Main Street, and a change of stance. The RBI, led by Urjit Patel and advised by the new Monetary Policy Committee, cut benchmark rates by 25 basis points. Patel said that all 6 members of the MPC were unanimous in their rate decision to actually go ahead with that rate cut, as inflation was seen to be moderating and a good monsoon would only help growth going forward into the next few quarters. The repo rate was lowered by 25 basis points to 6.25%, and the RBI maintained that its accommodative policy stance would continue for the 4th quarter of FY17. The RBI pegged the inflation rate at 5.3% as it expressed its concerns over impact of the new 7th Pay Commission. There was also some good news for banks struggling with the NPA crisis. The RBI said it would ease debt restructuring norms under the S4 scheme, which will be put up by the end of October. So all of those factors played up and brought about a positive reaction from the equity markets, a positive reaction from the bond markets. Remember, bond yields getting into the policy event were already trading at 7-year lows. And that pretty much has been the appetite as far as the fixed income market goes. The currency is largely stable too. So all in all, the markets were comforted by this policy statement and the policy stance adopted. In fact, more than anything else, let's first go across and get you a quick roundup of what Governor Patel outlined in his policy view.
We have a great MPC. The 3 external members are of outstanding pedigree. They are very well-known academics. They have been involved in policy making of one sort or another for a long time, and they bring value and a dispersion of opinion, which is what the MPC is about. Our discussions were frank, often intense, but always friendly. What we have identified are some upside risks, but there are downside risks also. If you see that range, when we talk about 4.5, it's very large. If I look at over the next 7-8 quarters, the government has introduced structural policy reform policies, which is of course done to ease supply constraints. The NPA situation is an important issue for the RBI in India. We will deal with the situation with firmness, but also with pragmatism, so that the economy does not feel any lack of credit to support the growth in the economy. But we must remember that this situation has not occurred overnight and therefore will require skill and thoughtful endeavor to resolve. There are many reasons that led to this situation, but now helping banks to deal with this situation is of the utmost importance for the country. We will move at various levels to address the situation, and we have indeed done so. We are working with the banks and the government on the subject.
S4A, which is part of the scheme to deal with the stressed assets, there was this idea that the sustainable portion of the debt, irrespective of what it was before, when it is sustainable, why should it not be classified as standard? So we have agreed to that, and of course we'll be coming out with some final guidelines on that. There will be certain conditions subject to which it will be done, so that it is not used for wrong cases. So, but we'll come out with guidelines in those areas by end of October.
In fact, let's cover all angles and get you the best opinion there is among policy watchers, market watchers, as well as members from the industry. Best reaction coming in from all quarters to this rate cut decision by the RBI under the Monetary Policy Committee regime. Joining us right now are Nilesh Shah, MD, Kotak Asset Management Company, Sajid Chanoy, Head Asia Economics at JP Morgan, and Rajneesh Kumar, MD, National Banking at SBI. They all join us with their perspective. And we also have Mr. K.K. Mistry joining us on the phone line with his views on this rate cut decision. But let me start off first with you, Sajid, and your own sense, your own reaction really coming in to this rate cut announcement.
Firstly, a number of facts have changed in the last couple of months. Back in August, there was still uncertainty about how food prices would pan out, whether in fact the monsoon would be normal, both in quantum and spatial distribution. And the fact is the data has begun to soften materially. August CPI was at 5%. Our forecast for September is 4.5%. I think by October it goes down to 4.2%. So inflation risks have moderated in the last couple of months, and core inflation, which was sticky at 5.5%, have come down to 5.1 or 5.2. So there has been a softening both in food and in core, and therefore I think today's action is perfectly justifiable. I don't think there is the danger of groupthink on the MPC. We've got, I think, an excellent choice of MPC members. They bring different backgrounds and different strengths to the table. I think today's was a relatively straightforward decision. It was just a question of timing, today versus December. I'm sure, as the MPC continues its work and as more trade-offs may rise 6, 8, 10 months down the line, maybe you don't get a unanimous decision every single time. That's the nature of the beast. But today, I think I'm not surprised either by the decision or by the fact that it was a consensus on the MPC.
Oh, you're absolutely right. It was in line with consensus and broadly the market expectations as well. Mr. Mistry is with us of HDFC Limited. Mr. Mistry, how do you react to this rate cut decision? And I particularly want to ask you, what would this rate cut do for the sector, which the previous 150 basis points worth of rate cuts haven't done so far?
I think the rate cut was expected. All the macro data that you see around you inspires a lot of confidence. Current account deficit has come down. We were even talking of a possibility of a current account surplus. Fiscal deficit has come down. Inflation has come down. Rupee stable. So all the macro indicators were such that one could look at a reduction in interest rates. So therefore, one should not be surprised at all at the decline. What does it do? Well, it obviously reduces the incremental cost of funding for people. But what you need to understand is that just a reduction by RBI does not necessarily translate into an immediate reduction in the cost of funds of a bank unless and until they start lowering their deposit rates. So this is a process which has to happen. It cannot happen that RBI cuts rates by 0.25% today and the next day the cost of funds of a bank comes down by 0.25%. It doesn't work that way. But clearly, incremental funding cost is getting lower. As incremental funding cost keeps getting lower, the benefit of that lower cost is being passed on to consumers, though at a slower pace.
Two statements that stand out to my mind in the policy. One, of course, the fact that they have admitted that there are some pressures on, the cost push side of inflation, which can bob its head going forward. Second, of course, they have indicated that the investment climate has been subdued. It hasn't picked up as per expectation. On both those fronts, do you believe that going forward the RBI would be a bit more cautious, or are they indicating that the bias is towards more rate cuts than than previously suggested?
I think RBI may be a little watchful on this front because there are 2-3 events which they will need to keep in mind. One is that on the positive side, we've seen good monsoons, which therefore would translate into good food crop as the harvest season picks up, which means more money in the hands of people, which means more consumption. But as consumption increases, that coupled with the fact that there has also been a lot of government spending in rural areas, which will result in more income in the hands of people, is all very positive, but it results in more consumption. And the third is the pay hike to the government employees, which will also increase consumption. So as demand and consumption increases, it can put a little bit of pressure on commodity prices, or on prices, basically. Second is the fact that you have to look at the U.S. interest rates also. In December, U.S. would be pretty much likely to increase rates. Plus, you have the U.S. presidential elections coming up next month. So I think these are 3-4 factors which RBI will probably need to keep in mind when they take a policy going forward on interest rates. So I think it's too early to take a call, but I think RBI will look at things with a very open mind.
Right, but now with 175 basis points, pretty much given to the sector, do you think we can see meaningful changes? You highlighted the fact that, going forward, the much anticipated transmission would happen. It would take a little bit of time. But how would that play out? While banks may cut rates or financing companies such as yourself may also follow suit, has the demand environment changed? I mean, you need to have borrowers to create that credit demand. I mean, are they coming
See,
back to the market?
if you're looking at demand, in two ways we look at demand. One is wholesale demand, and the other is retail demand. I don't think retail demand ever really slowed down. And to my mind, a little reduction or increase in interest rates does not significantly change demand. Demand is more a function of so many other factors, not just interest rates. Similarly, when you talk of wholesale demand, which is pickup in the investment cycle, which is the time companies need money for expansion, whether it's more in terms of capex or purchase of capital equipment, whether it's in terms of purchase of real estate or whatever it be, that is again more a function of demand. So as demand in the economy picks up, and my sense is demand will pick up because today the urban economy is fairly buoyant. It's the rural economy which soon, coupled with government spending, coupled with the pay hike, will all result in increased rural spending. And as rural spending increases, that coupled with the already existing strong urban spending will result in faster capacity utilization. And as capacity utilization increases, my sense is we will see a pickup in investment. So it will come with a bit of a lag, but it will certainly come. And I would be very surprised if in the next 2-3 quarters we don't see a reasonably large pickup in the investment cycle, private sector investments.
Okay, I'll particularly hold that thought because that's going to be an important trend to watch out for. When does the investment cycle actually pick up in a constructive manner? Rajneesh Kumar is here with us as well. Mr. Mistry, stay on with us. We need to go across and get another perspective. Rajneesh, what's your own reaction to this rate cut and what it does for the course of action going forward?
Yeah, that is what I had said, that the conditions are ripe for a so as I had said in my remarks that conditions are ripe for a rate cut, and whether it happens now or in December. So 25 basis point rate cut, I think it is a welcome thing, and maybe in December also we can expect another 25 basis point rate cut, because inflation as per our research indicates that it may be sub 4 by December. So I think that is one of the factors which goes into determining the interest rate, and we don't have a full statement as of now about what is the stance of the monetary policy. When we go through that, there will be more clarity. But 50 basis point up to financial year 17, that has been the expectation, and now half of it is met, and remaining half, which is 25 basis point, maybe in December it is a possibility.
Okay, and from a market standpoint, Nilesh, the equity market seem to be comforted by this rate decision. We've already seen a big rally in bond markets. Yes, part of that rally is to do with money actually flooding emerging market bonds, but part of it also was the market's expectation that there would be a rate cut in this policy meet. Where do the markets take forward the story?
The 25 basis point cut is what was marketed already priced in. Now, as Sajid mentioned, it will be the extent of dovishness which will support the market. Clearly, market is not satisfied with 25 basis point rate cut. They had expected probably between 25 to 50 basis point rate cut over next 6 months. 125 basis point is in the pocket. Now it will be over to the commentary about future, where the extent of dovishness will support the market.
And Sajid, I posted this question to Mr. Mistry as well, asking him about, what's the way forward? Do you expect more rate cuts by March 2017? And do you expect the RBI to be more aggressive with rate cuts going forward, or, they would be a bit more cautious? So it's not a linear path from here.
It would surprise me if we have more than 125 base point cut till March. It won't surprise me if you get a little more easing next year, and I'll tell you why. Two parts to note in the RBI guidance. One is that they believe that there are still some upside risks to 5% in March of 2017, albeit they're quick to point out the risks are less than what they believed 3 or 6 months ago. So I think that may constrain how much space you have between now and 5%. I think the other point is, reading between the lines, it seems the RBI is going to treat 4% more as a medium-term target. There is no mention of a 2018 target, which gives them a little more space down the line. So next year, if in fact they believe average inflation is 4.5% and growth impulses aren't particularly strong, I won't be surprised if you get a little more easing. So to answer your question, I think perhaps one more cut between now and March, and then of course depending entirely on the data next year, still the possibility of a little bit of easing next year, given that the 4% now has to be achieved sort of over the medium term and not necessarily by March 2018.
It's all about signaling, right, Nilesh? So do you expect 25 basis points over the course of the next 6 months, or at best 50?
I think there is a fundamental issue here. We are ignoring wholesale price inflation and focused on consumer price inflation. And then on the other hand, we are taking into account sometimes the treasury bill rate, sometimes the repo rate, to say that this is real effective exchange rate. Ideally, in an economy like India, it's possible to find out what is the average lending rate of the banks, which provides bulk of the credit. If you are comparing CPI on one side, then it might be worth comparing average borrowing cost of Indian entrepreneur to arrive at what is the real effective interest rate. That's the interest rate which a producer is paying. If you are ignoring WPI, then probably it's worth taking into account actual borrowing cost of producers in order to arrive at real effective rate. If we go by that kind of theory, then there is ample room for rates to go down. If we go to the global markets, there also in most developed nations, the real exchange rate, the real interest rates are not really that wide. So my feeling is that over a period of time, we will develop our own definition of real interest rates, which is more inclusive, which does balance between consumer as well as a depositor as well as borrower.
Mr. Mistry, come in on that point, because that's also one of the highlights from
I'm
the policy
sorry, I
statement.
lost you for a while. So if you could repeat what your question.
No, Mr. Mistry, I was essentially, taking a leaf from what Nilesh just said about, real effective interest rates and real interest rates for the borrowers versus real interest rates for the depositors. You yourself highlighted that, the way for deposit rates is lower. But, in the previous regime, there was some sort of a target that was laid at, keeping real rates between 1.5% to 2%. This rate action and perhaps rate stance would mean that the RBI would look at more rate cuts going forward, perhaps, even do away with that stringent target and be more flexible on what this would mean for real interest rates, especially real interest rates for the depositors.
Well, my sense is that RBI clearly is now looking at growth as much as they are looking at inflation. I don't think we can put a number and say it's going to be 125 or 150 or whatever would be that number on real interest rates. But clearly, the trend is towards plenty of liquidity. Liquidity will result in lower interest rates in the course of time. It's already resulted in lower interest rates. And if this kind of liquidity is maintained, we probably will see further reduction in rates. What would be the outlook going forward? I think it's too early to take a call. There are too many external factors which we need to keep in mind. The impact of higher consumption, the impact of U.S. rate hike. Not that these are by itself major events, but a combination of 3-4 events like this, oil prices globally, commodity prices globally, a combination of all these factors will have to be taken into account whilst taking a call on interest rates. So I do believe there may be some scope to look at interest rate reduction, but I don't think it's going to be that significant number.
Give us your own sense of what's happening in the housing market and how the cost of borrowing coming down would really spur demand. Are you seeing changes on the ground?
Well, I can't comment. We are in a close period at the moment, so I can't talk of the last quarter. But if you'd have seen the quarter up to June, the demand for housing was very strong.
Okay, thanks very much, Mr. Mistry, for joining us and giving us your perspective as well on to this important rate cut decision. Timely as well, because the market was working with the assumption that this rate cut would come by. It was a window of opportunity given that we are stepping into US presidential elections at the start of November, and then come December, everybody's going to be keeping a close eye on what the Fed does next, whether or not they actually go ahead and give the US economy the first rate hike for 2016. Sajid, I just want to come back to you. Is there some contradiction in the RBI action and its statement on inflation? Because they have indicated that there are pressures via the cost push side, which they need to keep on their radar.
We're being a little hard on the RBI. Listen, not every single indicator will line up, with or be consistent with any one action. That's true of any central bank in the world. The fact is, this is flexible inflation targeting. You take many factors into mind. Now, as to your point on inflation for expectations, 2 points to note. One is the RBI has to be thinking forward and saying, where is inflation? Where will inflation expectations go 3, 6, 9 months from now? I agree with you. September inflation expectations were elevated, but remember, in India, inflation expectations are very highly correlated with certain food items. So if food prices go up, high frequency food prices go up, milk, vegetables, pulses, that tends to drive up expectations. If the RBI's belief is, and if you look at their guidance, their logic is very much that the actual momentum of food inflation has come down, and most of their forecasts are predicated on that remaining relatively well contained, then one can reasonably argue that, listen, if in fact food inflation is going to moderate, then that will have a salutary impact on consumer inflation expectations as well. So I'm not too fussed about any one data point. I think the fact is, we're now inflation's been running in the 4 handle for much of the next 4 to 5 months. We're going to undershoot 5%, and a little bit of space for monetary easing had opened up.
Okay, gentlemen, just stay on with us. Moving on to an ET Now exclusive finance secretary, Mr. Ashok Lavasa has given a big thumbs up to the governor's first policy statement, calling it a decision that will propel growth. Speaking to ET Now's Ruchi Bhatia, the finance secretary insisted that RBI's move will not only boost market sentiment but also boost liquidity.
A decision which will propel growth. It is something which many people in the market had been expecting. The fact that it is the result of a wide-ranging discussion shows that the sentiment was unanimous.
So, the fact that the new Monetary Policy Committee has also highlighted that due to the 7th pay panel recommendations, as well as if the standard rate for the GST is at 18%, this will have a moderate impact on inflation. So do you think that going forward from here, the target that we've set out, the medium-term target for inflation, that is at some sort of a risk?
The inflation policy which government has been following and which Reserve Bank of India has also shared, it talks of maintaining inflation within a band. As of now, the CPI inflation is within that band, and in this policy statement also Reserve Bank has said that they are hopeful that the band will be maintained during this financial year. The pay commission outgo and the money which it has put in the hands of people certainly increases their purchasing power. It releases more money in the market. To that extent, it does have an impact. But as I've said in the past, that increased demand in the market also has its positive side. After all, we are talking about boosting demand in the economy. So I don't think it's going to have an impact which is beyond this band.
You expect that this benign inflation outlook is going to continue for a while, isn't it?
I think all of us should hope for that.
All right. So, let me go back to the question of rates because, the markets were clearly happy with the kind of, decision that has come in from the RBI, from Mr. Urjit Patel in his debut monetary policy. Does it also go on to show that now, to much extent, the RBI and the government are in sync or on the same page with respect to pushing growth?
The Reserve Bank of India generally would take decision according to their assessment of the circumstances in the economy. And this time, RBI, of course, had inputs from the other members of the Monetary Policy Committee, who were clearly outside the Reserve Bank of India, but they were in their own right eminent economists, eminent thinkers, and their inputs and the views of the RBI members, as it has been reported, although the minutes are not yet out, but generally it has been a unanimous decision. So I think this Monetary Policy Committee has read the ground reality in the country and has taken a decision which, according to them, is good for the economy.
Okay, with that, we come to the end of this special edition of the Big RBI Reset. I just want to thank all our guests, Sajid, Nilesh, Mr. Kumar, as well as Mr. Mistry, for joining us and giving us a 360-degree perspective of what this means for the markets, for the economy, and for consumers at large. Thanks very much for watching this special edition.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.